Alan Gould of Loop joins us here at Post 9 talk about tonight's print. Alan, good to have you.
Hi, Carl. Thank you.
The general take we keep hearing is that the bar is high going into this print. Would you agree with that?
Yeah, the bar is high. When I speak to investors, everyone's expecting a good quarter. The anticipation is that they will beat the sub number. Of course, we don't have the sub number going forward that much longer, and that the price increase has been pretty well anticipated by the street.
Is there a big delta between what consensus is and what the buy side says about subs this quarter?
I don't think so. Well, buy side's probably $1 million or $2 million higher than consensus.
All right. So is the big number going to be that, or the guidance as long as we have it?
I think the guidance for 4Q is clearly 3Q is history. We want to hit the numbers, but the 4Q guide is what's all important.
What do you think's working here, and are they done sort of expanding their tentacles into different verticals, so to speak?
No, they're not done expanding. I mean, I do think they get more and more involved in sports. They went from sports adjacent programming to WWE, which is sports entertainment, to now 2 Sunday NFL football games, which that's as pure sport as you can get. So I think we'll see more in sports over time. They're spending more than anyone else on entertainment content. As the audience continues to grow and their subs and hopefully ad fees start kicking in, I think they'll start spending more on sports.
What is the number now on overall content spend at Netflix, or what's your expectation?
$17 billion or so.
All right, so yeah. It's been kind of flat now right? I mean, that number's been around for a bit.
It's leveled out the last couple of years since the strike. It actually went down 1 year during the Guild strikes, and it's back to where it was.
It's still an enormous number. What about the ad tier? We've talked a lot about it. It seems to be building, but slowly, perhaps even more slowly than had been anticipated when it was first announced.
Yeah, I mean, they talked about it being crawl, walk, run, and I'd say we've been in the crawl stage longer than anyone anticipated. But, they just came out with their engagement report. They had 94 billion minutes of viewership in the first half of the year. It was actually up 1% year over year. When you have the ratings, that viewership, eventually the ad dollars are going to follow suit. Now, what has to happen is they don't have as many members on the ad tier yet. That's growing. I think you probably need 50 million U.S. households to be of scale to the big CPG advertisers. I think they have maybe 20 million viewers in the U.S. right now. So they have to grow that. And also keep in mind, on the sports, like the NFL programming, everyone's going to be seeing the ads, not just the ad tier.
Well, you're stuck, too. I mean, it's still a feature of it that you can't actually go to another channel easily, at least in terms of navigating, which I think is a benefit for advertisers. What about the stock itself, Alan? What is it, 30 times, something like that right now? I mean, it's certainly not cheap.
No, it's not cheap. It's about 30 times this next year's earnings. But the key thing here is just look at where the industry fundamentals are going. The combined other legacy media company studios, they lost $10 billion 2 years ago on streaming. They lost $6 billion last year on streaming. They started getting religion, started going for profits instead of growth. They'll still lose $2 billion this year. We've probably seen more price increases by the competition over the last year than we've seen in years. So the prices were really unrealistically low for the consumer. They're probably still not where they should be. So as long as we continue to see price increases from the competition, less spending just to get subs from the competition, and of course we've all been waiting for some consolidation, so fewer players, I think the environment looks great for Netflix.